All right, so let's jump right in. We're going deep today on what went down in the U.S. futures and Forex markets on March 25th, 2025. We've got all those end-of-day recaps. And, well, our mission, if you will, is to really sift through all that data and try to understand what it all means for how investors were feeling and, just sort of get a sense of the economic vibe of the day.
Right.
And one thing that really caught my eye right off the bat was this weird kind of contrast. On the one hand, you've got this like almost bubbly optimism about, possible tariff adjustments that could be coming down the pipeline. But then on the other hand, you've got these really gloomy consumer confidence numbers, like
Yeah.
seriously downbeat.
Yeah, you hit the nail on the head. It's those kinds of contradictions, those unexpected twists that often reveal the most interesting stuff, right?
Mhm.
So let's break it all down step by step, shall we?
Absolutely. Let's do it.
But first, I think it's worth pointing out, just as a quick reminder, that the futures market, well, it's not really a single event. It's not like, boom, everything happens at once. Like if we're talking about equity futures or most commodity futures, those wrap up trading for the day around 5 p.m. Eastern time.
Right, right.
But you've got things like agriculture futures. Those actually close up shop much earlier, around 2:30 p.m. Eastern.
Yeah.
And then there's livestock futures, which finish even sooner.
Hmm.
So, it's a bit of a staggered process throughout the day.
Yeah, that's a good point. It's definitely not like the Forex market, which is basically going nonstop.
Exactly. Forex is like that ever-spinning wheel,
Yeah.
245. But let's get back to those futures.
Okay, yeah. So starting with stock futures, you've got the E-mini S&P 500 for June 25. That's the one that basically tracks the performance of 500 of the biggest U.S. companies, right?
Yep.
And that one closed up just slightly, like a tiny bump, like 0.08%, which, I mean, it is up, but it's pretty modest, especially after the strong day it had just before.
Mm-hmm.
Then you've got the NASDAQ, which is really heavy on tech, right? And that one also gained some ground.
Yeah, tech seems to be holding strong.
But then you look at the Dow futures, which is more focused on those big industrial companies, and that one, well, it's a bit of a mixed bag, honestly. Some of the contracts even dipped a little bit, which kind of makes you wonder if there's a bit of caution creeping in there.
Yeah, it's like a little flicker of hesitation.
And then there's the Russell 2000, and that's the index that tracks the smaller companies, kind of like the Main Street businesses, if you will.
Exactly.
And that one actually went down, which, it does make you think, right? Like, are those smaller companies getting hit harder by worries about the overall economy?
It's certainly a possibility. And I think the point you made earlier about that contrast in sentiment is really key here. The fact that big tech continued its climb while we saw these more muted gains in the S&P and even a decline in the Russell 2000, well, it suggests that this wave of enthusiasm over the potential tariff adjustments, well, it wasn't exactly universal.
Right, right.
It seems like the market might be realizing that not all companies, not all sectors, and certainly not all sizes are going to benefit equally from these changes, especially when you factor in the potential for broader economic ripples, Like, what if those tariffs have a bigger impact on consumer spending down the line?
Exactly.
So, yeah, the market was definitely starting to think a bit more deeply about all the potential consequences here.
So that's stocks. Then you've got commodities, right? And the story there is, well, oil futures went down slightly. Not a huge drop, but still edged down, ending up somewhere around $69 a barrel.
Yeah.
And you have to wonder, right? Like, were those ongoing tariff talks maybe causing some jitters about what demand for oil is going to look like down the road?
It's hard to say for sure, but I think it's a plausible connection. New tariffs, especially on countries that buy a lot of Venezuelan oil, could definitely put a damper on global economic activity. And less economic activity, well, that generally translates to less demand for oil.
Right.
So that slight dip in oil prices could be a sign that those concerns are starting to creep in.
Makes sense.
Mhm.
But then you look at gold, and that's kind of the opposite story, right? Gold, which is like, that classic safe haven asset, it jumped up, closed above $3,025.
Oh, yeah. Gold's behavior is textbook stuff here. When investors get nervous, when uncertainty hangs in the air, they tend to gravitate towards gold. It's seen as a more stable store of value, especially when things feel a bit shaky. And, with all this talk about tariffs, with anxieties about inflation and how the economy's doing, well, it's no surprise that gold got a little boost.
So to sum it up so far, we're seeing cautious optimism in some parts of the market, particularly around big tech, maybe a little bit of hesitation in the industrial sector, some potential economic fears hitting those smaller companies, and a split in commodities with gold rising and oil dipping a bit.
Yeah, that's a pretty good snapshot.
But we can't forget about currencies, what was going on in the Forex world on March 25th.
Right, so in the Forex market, the euro and the US dollar, they basically stayed pretty stable against each other, like not a lot of movement there.
Okay,
But the British pound and the Australian dollar, those both gained a bit of ground against the dollar.
interesting.
However, on the flip side, the US dollar got stronger against both the Japanese yen and the Canadian dollar.
Hmm.
So it's a bit of a mixed bag.
Yeah, definitely some different stories playing out there.
And I think a lot of it probably comes down to the specific economic conditions and overall sentiment in those various regions, right?
Okay.
Like what's happening in Japan is going to influence the yen differently than what's happening in Australia will influence the Aussie dollar.
Right, right. Makes sense.
Yeah.
So dollar strength against the yen and the loonie, stability against the euro, and slight weakening against the pound and the Aussie. Okay, so let's bring all this back to what we were talking about earlier, those economic indicators. That consumer confidence index taking a nosedive to a 4-year low. I mean, that's a pretty big red flag, isn't it? Especially with the expectations index also tanking.
Yeah, I'd say it's a significant warning sign. I mean, think about it. That drop in consumer confidence reflects how people are feeling about their own financial futures. They're worried about things like tariffs, inflation, just the general economic outlook. And when consumers are anxious, well, that can have a real ripple effect on the entire economy.
Absolutely. And that's what makes it so interesting when you contrast it with those generally positive stock market moves we were talking about earlier.
It really does highlight this disconnect, doesn't it? Like, on the one hand, you've got this segment of the market that seems to be laser focused on the potential upside of these tariff adjustments. Like, maybe they're thinking short-term gains.
Yeah.
But on the other hand, you've got this underlying anxiety, this unease among consumers that could really drag things down if it persists.
Right, right.
And I think the other economic data we saw on March 25th just adds to that sense of vulnerability. Like a contracting manufacturing index, only a tiny increase in new home sales. Those aren't exactly signs of a booming economy.
Not at all. And then, of course, you've got the global context. You mentioned those new U.S. tariffs on countries that buy Venezuelan oil. And then there's the ongoing uncertainty around those broader tariff policies that are still in play. And all of that, well, it's just got to be making it incredibly difficult for businesses to plan ahead. Like, how can you make long-term decisions when the trade landscape keeps shifting?
Exactly. And that uncertainty bleeds into the Forex market too,
Yeah.
right? Especially for those currencies that are really sensitive to fluctuations in global trade.
Mm.
I mean, when the rules of the game keep changing, it's hard to predict how currencies will react.
Yeah, totally. And then, of course, you always have those underlying geopolitical tensions, like, what's happening between Russia and Ukraine, what's going on in the Middle East.
Yeah.
Those things always have the potential to add fuel to the fire. They can affect commodity prices, they can ramp up risk aversion. It's all connected.
It's a tangled web for sure. But if we try to step back and look at the big picture, I think it's fair to say that that initial stock market surge we saw earlier in the week, that was probably fueled by hopes that those targeted tariff adjustments would be a good thing, especially for certain tech companies.
Makes sense.
But I think the more subdued activity we saw on the 25th, especially when you consider that gloomy consumer confidence data, well, it suggests a bit of a reality check.
Like the market's starting to process the bigger picture.
Exactly. And that comment from the Federal Reserve, the one that hinted that they might not be cutting interest rates as aggressively as some folks were hoping, well, that probably gave the U.S. dollar a little boost.
Okay.
And then, just from a technical analysis perspective, you've got the S&P 500 facing some resistance levels. You've got Treasury yields dropping because of that weaker economic data.
Yeah.
All of that points to continued volatility. We're not out of the woods yet.
So let's bring it all home. It sounds like March 25th, 2025 was a day of mixed signals, of conflicting forces, where you've got this optimism about potential policy shifts, but it's bumping up against some pretty hard economic realities. And all of that tension played out in these subtle, sometimes contradictory movements we saw across the futures and Forex markets.
You got it. That's the essence of it. It's almost like the market's trying to figure out in real time how to weigh those potential benefits against the risks, how to balance the hopes with the anxieties. It's a fascinating process to watch unfold.
It really is. So here's a question for everyone listening. Given this really clear split between that market optimism and that wave of negative consumer sentiment, which force do you think is going to be more powerful in the long run? Will it be the market's reaction to those policy changes, or will it be the actual feelings and behaviors of consumers that ultimately dictate the direction of the U.S. economy? It's a question worth pondering, and it's something we'll be keeping a close eye on in the coming weeks and months. Thanks for joining us for this deep dive, and we'll catch you next time.
See you then.